Hello and welcome to Insight AI Brief Set. Today we're going to talk about the stock CCET. And yeah, we're really excited to unpack this one for you.
Absolutely.
But before we get started, please don't forget to follow, like, and share. It really helps support our team.
It does, yeah.
So we actually received a fascinating brief from you, our listener, part of what you've called your Insight AI Brief Set, asking specifically for a deep dive into this stock, CCET. So what's our mission today? Well, we're aiming to cut through the noise around CCET. They're a pretty prominent player in the electronics manufacturing services, that's EMS sector, right here in Thailand.
That's right. A major name in the region.
Exactly. And we'll be exploring their most recent financial performance, looking at their strategic roadmap for the future, what the analysts are saying about price targets.
Yeah, the forecasts.
Their dividend policy, financial stability, the whole picture. And then finally, we'll pull it all together into a concise investment summary.
Sounds good.
And really, the overarching question for this deep dive, I think, is can CCE, a company that's, let's be honest, seen its share of volatility, can it truly transform into a stable growth powerhouse for the long term?
Right. Or is it still more of a tactical play?
Exactly. Is it for investors maybe with a higher risk appetite? Let's unpack this.
That's an excellent framing question.
No.
And it really sets the stage perfectly for what we're trying to achieve here. And to answer that, we've pulled together insights from, well, a really diverse range of sources for this deep dive.
Okay. This
isn't just us reading, a single analyst report. We've really dug into the latest company announcements directly from CCE themselves. We've sifted through comprehensive market data from the Stock Exchange of Thailand and critically evaluated these in-depth perspectives from leading analysts, folks at places like Maybank Securities and Beyond Securities.
I got it. Respected names.
Definitely. And we've also cross-referenced with insights from financial news outlets like Manager Online and used market data platforms like TradingView to get a broad picture.
So a real 360-degree view.
That's the goal. We want to provide you with a clear, structured understanding of CCET. Arm you with those sometimes surprising facts, the crucial context that hopefully sparks those aha moments.
Right.
But without that feeling of information overload, you get trying to piece it all together yourself from like 10 different reports.
Yeah, cutting through the noise.
Exactly. We're here to connect the dots, offer a holistic view, and help you understand not just what is happening, but crucially, why it matters.
Perfect. So let's dive right into the heart of it then. The numbers. An 86.93% jump in net profit for the first half of 2024. I mean, that sounds astounding.
The headline number.
But for our listeners, what does a jump like that magnitude, truly represent for a company in the EMS sector? Is this just, the whole industry getting a boost, or is CCET doing something fundamentally different?
That's precisely the right question to ask. Because an 86.93% year-on-year surge in net profit for H1 2024, well, it isn't just a strong number. It's really a testament to some significant fundamental shifts happening within CCET.
Okay.
While the EMS sector can certainly have its ups and downs, its cycles, this kind of growth suggests way more than just, riding an industry wave.
Right. It's not just luck.
Not at all. And to put it in perspective, 2023 itself was already a standout year for them. Net profit growth was hovering around 100%.
Wow. 100%.
Yeah. Now, that was partly attributed to starting from a lower base in previous periods, sure. So they were recovering, and growth could accelerate fast.
Okay, that makes sense.
But the crucial insight here is that this wasn't just a one-off bounce back. This strong momentum carried on consistently through Q2 and Q3 of 2023, and now clearly into 2024.
So sustained improvement.
Exactly. This isn't just a financial recovery. It really points to a strategic reengineering of their entire business.
Yeah.
If you look at the raw figures, their net profit shows this remarkable, consistent upward trend. It went from, 272.95 million Thai baht in 2021.
Okay.
It more than doubled to 810.30 million baht in 2022.
Big jump.
Then climbed again to 11,115.61 million baht in 2023. And for the latest period, the 9-month year-to-date profit hit an impressive 1,985.89 million baht. Compare that to 1,013.91 million baht in the same period the year before.
Huge difference.
It really is. And what this signifies for an EMS company, often operate on pretty tight margins, is that they're finding new, much more profitable ways to grow.
Yeah.
They're really differentiating themselves in what's typically a very competitive market.
That's a powerful narrative of sustained growth, like you said, in electronics manufacturing. It's genuinely rare and definitely deserves a closer look. So it's clearly not just bouncing back. There must be some deep shifts happening internally to drive that kind of consistent performance. What are the core strategic drivers? What's behind this remarkable improvement?
You've hit the nail on the head. This isn't just about, shuffling numbers around.
Yeah.
It's fundamentally about a strategic transformation. We can really pinpoint three primary drivers that have been instrumental.
Okay, let's hear them.
The first, and I'd argue maybe the most impactful, is CCET's product mix transformation.
Product mix, okay.
Yeah. Think of it like a chef completely revamping their menu. They've made a very deliberate, very strategic shift away from the lower margin stuff, things like older generation set-top boxes, which were basically commodities.
Right, everyone makes those.
Exactly. And they're now focusing intensely on what we call higher margin segments. This includes products like smart wearable devices, which are getting more and more sophisticated.
Smartwatches and fitness trackers.
Precisely. Also, solid-state drives SSDs, which are absolutely critical for high-performance computing, especially now with AI.
Ah, okay. Big demand there.
Huge. Also, components for the rapidly expanding EV charging infrastructure and advanced printer components that need, specialized manufacturing know-how.
So moving up the value chain, essentially.
That's exactly it. This pivot has a direct and very positive impact on their overall profit margins. It means each unit they produce now contributes significantly more to their bottom line. It's about quality over just quantity.
Makes perfect sense. What's the second driver?
The second key driver is their pretty aggressive pursuit of operational efficiency, and this is powered by cutting-edge AI integration.
Ah, AI. Everyone's talking about it.
And CCT isn't just talking, they're doing. They haven't just dabbled in AI. They've really gone all in, proactively adopting AI tech to optimize their entire operational landscape.
How so? What does that look like practically?
Well, imagine AI controlling entire production lines, acting like a highly precise, always-on conductor of an orchestra. This level of automation has led to really significant reductions in both labor costs. I mean, less human intervention means fewer direct labor expenses, obviously.
Right.
And also administrative expenses, because it streamlines their back office operations, too.
Wow. Is this already happening?
Oh, yeah. A standout example is their prototype Factory 1. It now operates, quite astonishingly, without any human intervention on its actual production line.
Seriously? A fully automated line?
Pretty much. It's not science fiction. It's happening right now. And they have ambitious plans for a wider rollout of this AI-driven automation across CCT's other facilities. That promises even greater efficiencies and could potentially set a whole new benchmark for the industry.
That sounds like a game changer for costs and quality control.
It really is. And finally, the third crucial element, the one that provided a sort of significant tailwind, was the impact of a capital increase they undertook back in 2023.
Okay, raising money. How did that help?
Well, it wasn't just about raising money for the sake of it. It was a very strategically executed financial move. The funds they raised were primarily, and pretty immediately, used to pay down a substantial chunk of their existing debt.
Ah, deleveraging. Smart.
Very smart. It had this powerful dual benefit. First, it led to a significant reduction in their interest costs. Think of it like slashing your mortgage payments. It directly boosts your disposable income, or in CCET's case, their net profit.
Frees up cash flow.
Precisely. And second, it noticeably improved the company's debt-to-equity ratio, the DE ratio. For our listeners, the DE ratio is a key indicator of financial leverage, showing how much debt a company uses versus shareholder equity.
So a lower ratio means less risk.
Generally, yes. Less financial risk, a stronger balance sheet. This deleveraging provided a really robust financial foundation and clearly contributed to that boost in net profit, starting from Q1 of last year. It just freed up capital that would otherwise be going out the door to service debt.
That truly sounds like a powerful combination then. Optimizing products, supercharging operations with AI, and strengthening the balance sheet. It's a really holistic approach.
It is?
But, as any seasoned investor knows, past performance doesn't guarantee future results. So they've built this strong foundation.
Yeah.
What's CCET's vision for the future? Where are they heading strategically to keep this momentum going and capitalize on new opportunities?
Yeah, good question. Their future strategy is very much an intelligent continuation and even expansion of these successful initiatives. But there's also a really sharp focus on anticipating and capitalizing on these bigger global economic and geopolitical shifts.
Okay.
So first off, they remain deeply committed to that focus on high-margin product manufacturing. We talked about solid-state drives, SSDs.
Right, for AI servers and things.
Exactly. They're becoming increasingly important, especially with their use as memory units in the booming field of AI servers. This isn't just a niche market anymore. AI servers demand incredible processing power and fast, reliable memory. SSDs are absolutely critical.
And CCET is seeing demand.
Big time. We've seen a significant surge in their SSD export figures, jumping dramatically from around 30 million US dollars to 60 million USD recently.
Doubled. Wow.
Yeah. And this isn't just them observing a trend. Factory 16 is already up and running, supporting this increased SSD production. So they're translating that demand into actual manufacturing capacity now.
Okay, what other high-margin areas?
Another one is EV charger components.
Yeah.
Here, CCET acts as both a JDM, that's joint design manufacturer, and an OEM, original equipment manufacturer, for ChargePoint.
ChargePoint, the big U.S. charging network.
That's the one, a leading U.S. provider. And for listeners, being a JD OEM means CCET isn't just snapping parts together. They're often involved in the product's design, the specs. It signifies a deeper, more valuable, and usually higher margin partnership.
Right, more integrated.
Exactly. However, it's important we acknowledge an analyst's caution here. There's concern about the potential impact of, say, a new U.S. administration maybe having a less supportive stance on EVs. That could possibly temper growth expectations in this specific segment.
So one to watch carefully.
Definitely. It might not deliver the same kind of exponential growth we see elsewhere, but on a more consistent note, smart wearable devices continue to show steady growth. This is driven by recurring orders from their big tech clients.
The Apples and Samsungs of the world, presumably?
They don't name names, but yes, think major global tech brands. This contributed notably to their order book in Q3 last year, and they're seeing continued strong orders flowing into 2024 and 2025.
Okay.
And finally, semiconductor equipment is another area they've identified as a key high-margin focus, again highlighting their continued move into more specialized, higher-value manufacturing.
So they're definitely not just riding the tech wave, they're being quite strategic about which parts of the wave they ride and realistic about external factors too. That sounds smart.
Very much so.
But often, the biggest waves aren't internal strategies. They're these huge external shifts. I'm thinking specifically about the shifting sands of global supply chains, geopolitical tensions. How is CCE positioning itself to maybe capitalize on, or at least navigate, those massive production relocation trends we keep hearing about?
This is truly where CCT seems to be demonstrating some real strategic foresight and agility. Their management is actively anticipating and looking to benefit from these global supply chain realignments. You hear terms like friendshoring or reshoring.
Right, moving production out of certain countries like China.
Exactly. They expect to see a significant number of customers relocating production to Thailand, specifically to mitigate risks from potential U.S. import tariffs that might arise or intensify after the U.S. elections, particularly targeting goods currently sourced from China.
And this is a real trend.
Oh, very real. It's tangible, impacting countless global manufacturers. And CCE is positioning itself to seize this opportunity. For example, we hear that 2 major laser printer clients are reportedly very close to signing agreements.
Okay. To shift a substantial portion of their production away from competitors in China, and in some cases Vietnam, directly to CCET's facilities right here in Thailand.
Wow, that could be huge. When would we see that impact?
The visible impact, the increased output from these transfers, is expected to become quite clear in the first half of 2025.
Okay, next year.
And Maybank Research even put some numbers around this potential. They noted that these new laser printer clients, once they're at full production, could contribute an additional 20-25% to CCET's 2024 revenue baseline.
20 to 25% extra revenue, just from those 2 clients.
Potentially, yes. That's not just a minor upside. It's a significant potential boost to their top line, really demonstrating their ability to capitalize on these big macro trends.
That's fascinating. It really sounds like they're playing chess, while maybe others are playing checkers, positioning themselves exceptionally well for these shifts. But the critical question for listeners has to be, are they actually ready from a capacity standpoint?
New orders are fantastic, but if you can't fulfill them efficiently, it's a huge missed opportunity, right?
Absolutely. Capacity is key. And they are definitely thinking ahead here. Management isn't just, crossing their fingers hoping for increased purchase orders in the second half of 2024. They've been proactively ensuring their new manufacturing facilities are primed and ready.
Okay. What facilities are we talking about?
Well, Factory 16 in Mahachai is already fully operational. As we discussed, it's actively supporting that increased SSE production right now. That's not theoretical, it's already contributing.
Right, Factory 16 is online.
Yep. Additionally, they have factories 13, 14, and 15 down in Fitchbury. These are all prepared to handle new orders. The plan is for trial, runs for these factories around December 2024.
Okay, end of this year.
With clear order visibility, meaning confirmed. Large-scale production ramping up expected in the first half of 2025. It's a layered approach, showing pretty disciplined expansion.
And is it just Thailand?
No. Beyond Thailand, there are also ongoing test run phases for new facilities in Sanut Sakan, Phetchaburi, and this is particularly interesting, a strategically important one in Sao Paulo, Brazil.
Brazil. Why Brazil?
That's the fascinating part. It's about the strategic role of that 100% owned Brazil factory.
Yeah.
Why Brazil? Because it offers a significantly lower import tariff rate, just 10% into the crucial U.S. market.
Ah, a tacit advantage.
Exactly. It provides a critical, highly cost-effective alternative pathway for exports if tariffs from other regions, like maybe Southeast Asia, become prohibitive. It really showcases their global contingency planning.
Okay, that Brazil factory sounds like a very smart hedge, but this raises the even bigger question. What about those U.S. tariffs generally, the ones that could significantly affect the whole electronics sector?
Yeah.
We've seen so much back and forth. It's a constant worry for global manufacturers. How is CCET specifically addressing these potential risks beyond just having the Brazil option?
It is a critical point, and frankly a complex one, that every global EMS provider is wrestling with right now. The current tariff landscape is definitely fraught with uncertainty. U.S. import tariffs on certain electronic goods can be as high as 36%.
It's 36%. That's huge.
It's substantial, a huge increase from the previous range of maybe 5–10%. This is no small sum. It can fundamentally alter the cost structure of goods entering the U.S.
So what's CCET's plan?
They have a proactive and actually very well-defined strategy for this. It demonstrates a high level of preparedness. If tariffs escalate and cross, let's say, a 20% threshold,
Okay.
the company will immediately consider relocating production. Their primary options include utilizing their existing factory in the U.S., which bypasses import tariffs entirely, obviously.
Right, domestic production.
Or shifting production to their base in the Philippines.
All right.
Remember, CCET holds a 19% stake there, and their parent company, Kinpo, owns the majority 81%. So they have leverage and operational presence there too. This diversified manufacturing footprint is a major asset.
So U.S. or Philippines as backup options.
Exactly. However, and this is important, there are several mitigating factors that kind of buy them time and flexibility.
Okay, like what?
First, only about 30% of their existing production lines are physically capable of being relocated without significant investment or disruption. So a full rapid shift isn't simple or even possible for everything.
Ah, logistical constraints.
Right. Second, their Philippines facility, while it's an option, is apparently operating at full capacity right now.
So no immediate room there.
Not immediately, which gives Thailand and CCET additional breathing room, maybe time to negotiate tariff rates, or for customers to adjust their own supply chains.
Has some time.
And third, as we just highlighted, that wholly owned factory in Brazil offers a highly viable alternative with that significantly lower tariff of just 10%.
The Brazil safety net.
Precisely. So while the tariff risk is absolutely real, CCET's management is clearly vigilant. They're closely monitoring global customs policies. They're in continuous communication with their customers to adjust production strategies based on regional demands. It's all about minimizing disruption and protecting their margins. It's really a dynamic, ongoing process, not just a static threat they're waiting for.
That's a very detailed and, frankly, reassuring plan for managing tariff risks. It shows considerable foresight.
Okay, what about currency fluctuations? Another big headache for exporters. Many companies dealing internationally are extremely vulnerable if their local currency strengthens, right? It can just erode profits away. How does CCET manage that dynamic?
That's another perceptive question because, yes, currency volatility can be a silent killer of profitability for export-focused companies. CCTT's management has a very clear, very disciplined approach here.
Yeah.
For starters, 100% all of CCT's revenue is denominated in U.S. dollars.
All of it. Okay, that's key. Absolutely crucial. It means their top line is consistently priced in the global reserve currency. Now, on the cost side, about 85% of their costs are also in U.S. dollars. Mainly for raw materials, imported components, that kind of thing.
So a natural hedge there for the most part.
Exactly. Now, regarding the remaining 15% of costs, while some sources might have had a slight ambiguity, Our research confirms this portion is denominated in local currency, which means the Thai baht.
Okay, 15% in baht.
Right. This careful balance with the vast majority of both revenues and costs in US dollars acts as a pretty effective natural hedge. But what's even more important, perhaps, is that management anticipates minimal impact even from a strengthening Thai baht,
How?
because they believe they possess a strong ability to pass on any increased raw material costs related to that 15% local currency portion directly to their customers.
Ah, the cost pass-through mechanism.
Exactly. This provides a robust hedge against currency volatility. It essentially ensures their margins are protected, or largely protected, regardless of the Thai baht's movement against the dollar.
Hmm.
It demonstrates significant pricing power and probably pretty strong customer relationships, too.
Okay, so they've got robust strategies for tariffs, for currency, two of the biggest external variables for a global manufacturer like them. Given all these strategic moves, the new capacities, the risk mitigation, what kind of growth are analysts genuinely expecting? What do the hard projections look like for the next few years?
Looking ahead, the analyst consensus seems to suggest a projected net profit growth for 2025 at around 20%.
20%. Still very healthy.
Absolutely. Still a very healthy rate.
Yeah.
But it's acknowledged as being a bit of a deceleration compared to the, frankly, explosive growth we saw in 2024.
Because the base is much higher now.
Precisely. It's due to building upon that much higher comparative base.
Yeah.
Think of it like climbing a steeper hill. The absolute gains are still significant, but the percentage growth rate naturally moderates a bit.
Makes sense. What about beyond 2025?
Well, the forecast for core profit growth in 2026 looks even more robust, actually around 31%.
31% in 26. Okay.
Yeah, indicating that the underlying strategic initiatives, that product mix shift, the AI efficiency, the new capacity, they're expected to deliver strong, sustained momentum beyond just the immediate horizon.
Interesting. What about revenue growth? You mentioned profit growth is strong.
Right. Interestingly, the revenue growth projection for 2024 itself is more conservative, estimated only around 1%.
Only 1% revenue growth, but huge profit growth.
Exactly. It suggests that much of the profit growth, at least in the near term, is being driven by that margin expansion, the shift to higher value products and maybe cost efficiencies, rather than just massive top-line volume increases this year.
So more profitable sales, not just more sales.
That seems to be the story for 2024. Now, it's also worth noting a key nuance here. The analysts' 2025 projection of 20% net profit growth. Well, it's actually considered quite conservative by some.
Oh, why is that?
Partly because the full impact of those new factories, 13 and 15, the ones tied to potential customer relocation, isn't yet fully factored into their models. There are still lingering uncertainties around exactly when those customer production shifts will fully materialize and ramp up.
Ah, so there could be upside to that 20%.
Exactly. It implies there could be additional upside to these projections if those relocation plans solidify faster or bring in more business than currently modeled. It's a case where the analysts are being prudent, understandably, but the underlying potential might actually be even greater.
All right, this is fascinating stuff. Let's get to the question I know many of our listeners are undoubtedly asking. What are the experts truly saying about CCET's stock price?
The targets.
Yeah, what are the targets we should be looking out for? This is where all that financial and strategic analysis kind of funnels down for investors, the bottom line, so to speak.
Absolutely. This is the practical application of everything we've discussed.
No.
So according to data compiled from TradingView, which aggregates forecasts from, I think, 3 different analysts over the last 3 months, the average price target for CCET for 2026 is 8.03 Thai baht.
8.03 THB. Okay, is there a range around that?
Yes, and the range is quite informative. The most optimistic estimate comes in at 9.00 THB.
9 baht on the high end.
Right, and the most conservative estimate is 7.20 THB.
Okay, 7.0 to 9.00.
Pretty much. Now, breaking this down further, Maybank Securities, a prominent institution, currently maintains a buy recommendation on the stock. They recently adjusted their target price slightly to 9.00 THB. It was actually a minor reduction from their previous 9.2 THB target.
Oh, slight trim.
Yeah, maybe reflecting a slight recalibration, but still, 9.00 THB indicates strong upside potential from where the stock is trading now.
Okay, what about other analysts? You mentioned Beyond Securities.
Right. Delving into their view, the analyst Thapal Nguyen from Beyond Securities assesses a fair value of 7.20 THB.
Okay, the lower end of that range we saw.
Exactly. And this valuation, the 7.12, implies a price-to-earnings ratio, or PE, of 24x for 2025.
PE of 24 times 2025 earnings. How does that compare? Is that high? Low?
Well, 24x isn't excessively high for a company with the kind of growth CCET is showing, especially in the tech manufacturing space. But it's crucial to understand how they arrived at that 7.20 value. It's based on what they call a base case scenario,
Base case.
meaning it specifically factors in the operational status of Factor 16, which we know is already up and running and contributing. However, and this is a really key point, it does not yet fully incorporate the potential impact and full operational capacity of Factors 13 and 15.
Because of those relocation uncertainties we talked about.
Precisely. So this base case of 7.20 could potentially see further upgrades if those factory transfers materialize fully and bring in more business than currently assumed in that base model. There's potential upside baked in if things go well.
That's a very helpful breakdown of the targets and the assumptions behind them. So analyst targets are roughly 7 to 9 baht, with some upside potential linked to those new factories really kicking in. But let's ground this in reality for a second. What about the current trading price?
Right.
And how does it compare to its recent history, especially given its reputation as, well, something of a hot stock at times with those rapid, sometimes dramatic movements?
Let's bring it right up to date. As of July 2nd, 2568, around mid-morning, CCET was trading at 5.35 Thai baht.
5.35 THB. Okay, significantly below those targets.
Yes. On that specific day, it showed a modest negative change, about negatives 2.73%, with an intraday high of 5.50 THB and a low of 5.3 THB. Pretty tight range that day.
Okay. Now, tell us about that history, the hot stock part.
Right, this is where the aha moment might come in for some listeners who remember it. CCE has a fascinating, at times, frankly, tumultuous past in the market.
Yeah.
It's been somewhat likened to Delta, another Thai electronic stock known for those rapid, dramatic price surges that attract significant speculative interest. CCET itself was once nicknamed the fan stock, apparently a popular speculative play that often saw incredibly volatile swings.
The fan stock. Interesting. Give us an example of that volatility.
Okay, consider this. From a 12-month low of just 1.49 THB, and more specifically, from 3.92 THB on October 8th of a previous year, the price absolutely surged to an intraday high of 9.70 THB by October 23rd.
Wait, from under 4 baht to nearly 10 baht in about 2 weeks.
Roughly, yes. It eventually closed that day at 8.75 THB, but that represents an astonishing approximate 1,200% increase over roughly just 1 month.
1,200%. That's incredible, like watching a rocket launch.
It really was. Now, at its peak during that parabolic surge, the PE ratio hit 46x, according to Manager Online.
46 times earnings. Pretty rich.
Significant, yes, though it's worth noting, still lower than Delta's PE, which at times went over 100x. So even at its peak froth, CCET's valuation wasn't quite as extreme as some other speculative plays.
Okay. And where is the PE now, based on current forecasts?
While Maybank, in their analysis, points to a 2025 PE ratio, based on current price levels and their earnings forecasts, of around 17.9x.
17.9x, that sounds much more reasonable.
We certainly consider it quite attractive, especially given the robust growth expectations we've just discussed. It implies there could still be value there if you believe the growth story plays out.
Okay, that kind of surge in volatility definitely gets and keeps investors' attention. So given this whole context, strong growth prospects, new capacity coming online, but also this history of dramatic swings and a current price that might already reflect some of the base case, what's the most prudent investment recommendation from analysts right now? Is now a good time to jump in, or should investors approach with maybe a bit more caution?
Well, the analyst's view, particularly Sapon and Gernseng, when the price was hovering around 7 THB at the time of his interview, was that it was considered quite tight, or maybe even stretched.
Tight or stretched at 7 baht.
Yeah. What this implies is that at that level, the stock already largely reflected the base case growth scenario, and maybe some of the initial excitement around those strategic shifts. So for investors looking for immediate, significant upside from that point, it might have been limited.
So what was the recommendation then?
The clear recommendation was to exercise patience. They specifically suggested waiting for the release of Q1 results.
Wait for Q1 results. Why Q1 specifically?
Because Q1 is typically a low season for CCET. It's due to cyclical factors common in the electronics industry. Demand patterns, inventory cycles, that sort of thing.
Ah, so the expectation is that the results might be weaker seasonally.
Potentially, yes, or at least not showing the same explosive growth as other quarters. This seasonal dip, the thinking goes, might present an opportunity for the price to soften or dip further, making it a more attractive entry point for investors who are waiting on the sidelines.
Let the price come to you, basically.
Exactly. The analyst even provided a specific buying target level, suggesting investors might consider purchases below 6 THB.
Below 6. Okay, that gives people a concrete level to watch.
Right, so it's really about strategic timing and disciplined entry, rather than chasing momentum, especially when the price might already be reflecting a good chunk of the known good news.
Waiting for a potential dip makes a lot of sense, especially with a stock that has that kind of history of rapid movements and these known seasonal patterns. But beyond just seasonality, is there anything else that contributes to its volatility? Something investors should be aware of that might catch them off guard quarter to quarter?
That's a very shrewd question. And yes, there is another layer of, let's call it, unpredictability. What's fascinating, or perhaps frustrating for investors, is that CCET's stock price can indeed be quite volatile due to what analysts often refer to as special items.
Special items, what are those?
These are often non-recurring, maybe one-off, or just generally unpredictable financial events that can significantly impact a single quarter's reported results. This makes comparing quarters tricky sometimes, and it can lead to unexpected share price movements.
Can you give an example?
Yeah, a common one in the manufacturing sector, and apparently for CCE specifically, is something called loss on disposal.
Loss on disposal. Selling old equipment.
Exactly. It typically refers to losses incurred when they sell or retire old machinery, equipment, or other assets before their value has been fully depreciated on the books.
And why would that happen often?
Well, for an EMS company that's constantly upgrading its technology, investing in AI, bringing new factories online, these asset disposals can occur sporadically as they modernize.
Makes sense.
But the key thing is, these items are inherently difficult to predict on a quarterly basis. So they can often surprise investors, leading to sharp, maybe unexpected movements in the share price that don't necessarily reflect the underlying operational performance of the business in that quarter.
So noise in the quarterly numbers.
Exactly. It's inherent unpredictability that adds a layer of risk investors just need to be mindful of. It's kind of part of the landscape for a company in constant technological evolution like this.
That's a crucial insight. Those special items can definitely throw a wrench into quarterly expectations and maybe create volatility unrelated to the core business. Okay, so beyond the daily movements and historical volatility of the stock, a deeper understanding always requires looking at the company's fundamental financial bedrock.
Absolutely.
So let's pivot slightly. Let's talk about CCET's dividend policy and its overall financial stability. What can our listeners expect there in terms of income, maybe, and balance sheet health?
Okay, sure. Regarding their dividend policy, the latest detail we have is that CCET paid 0.13 Thai baht per share last year.
0.13 THB per share.
Yes, and a key point here, one that provides a degree of reassurance for income investors, is management's stated commitment.
Yeah.
They aim to ensure that the dividend payment will not be lower than the previous years.
Okay, so a floor on the dividend, basically. Consistency.
Exactly. It provides a certain level of consistency and predictability. However, and this is important for perspective, you also need to look at the yield.
Right, the dividend amount relative to the share price.
Precisely. And while the payments have been consistent, the dividend yield has been historically quite low. It's actually fallen below 1% for the past 3 years.
Below 1% yield. That is low.
It is. So for listeners who are primarily focused on generating high dividend income from their investments, CCET probably isn't going to be their top pick. It's much more of a growth play, really, with just a consistent, albeit modest, dividend payout alongside it.
Okay, so manage expectations on the dividend front. What about the overall financial health? The balance sheet.
Now, this is actually a really strong point for CCET, and I think a significant de-risking factor for the company. We touched on it earlier, that significant positive impact of the 2023 capital increase.
Right, paying down debt.
Exactly. To reiterate and maybe add a bit more color, that move was strategically used to pay down a substantial amount of debt, significantly deleveraging the company. While the specific debt reduction figures weren't detailed in our sources, the analysts were clear that this action drastically reduced the company's debt-to-equity, or DE, ratio.
Which lowered their interest costs.
Massively. And consequently, its interest expenses went way down. This removal of a significant financial burden provides a really robust foundation for sustained net profit growth going forward, because more of their operational earnings can now flow directly to the bottom line instead of servicing debt.
That makes a huge difference long term.
It really does. Furthermore, CCET has demonstrated consistently positive cash flow from its operating activities, what accountants call cash flow from operations, or CFO.
Positive CFO. Why is that important?
Positive CFO is a very healthy sign. It means the company is generating ample cash just from its core day-to-day business operations to fund itself, pay its bills, reinvest, rather than constantly relying on external financing like issuing more debt or equity.
Self-sustaining.
Largely, yes. And they also seem to maintain a healthy, disciplined level of investment in their operations and expansion, reflecting prudent financial management. They're investing for growth, but apparently without overstretching their resources financially. This financial discipline significantly enhances their overall stability.
That's very reassuring to hear about their financial stability, the debt reduction, the positive cash flow. That sounds like a much stronger foundation than maybe they had a few years ago.
Definitely seems that way.
But what about things like corporate governance, ESG efforts? Institutional investors especially are increasingly scrutinizing these factors. They see them as indicators of long-term sustainability, responsible management. Is CCET on their radar in a positive way there? Or are there areas of concern?
Yeah, that's an increasingly important question, especially for long-term investors and, as you say, the big institutional players who integrate environmental, social, and governance ESG factors into their investment decisions. And CCE is certainly on their radar, and it seems to be in an increasingly positive light given their proactive efforts.
Oh, what are they doing?
Well, the company is actively working to improve its ESG standards across the board. They clearly recognize the growing importance of these criteria in attracting investment. Specifically, they're actively seeking to obtain a higher corporate governance, or CG, score from the Thai Institute of Directors, the IOD.
The IOD score. That's the main CG benchmark in Thailand, right?
It is. It's a key body that assesses corporate governance practices, providing a rating that reflects how well a company adheres to best practices in areas like board structure, shareholder rights, transparency, ethical conduct.
So aiming for a higher score is a good sign.
It's a very positive sign. It underscores their deep commitment to good governance and seems aimed at alleviating any lingering concerns that a potentially lower ESG score could deter institutional investment. It's a clear signal they're listening to market demands and want to appeal to that broader, more sophisticated investor base.
Where do they stand currently?
Well, they already hold a good CG scoring from the IOD as of 2023, which is a solid foundation to build on. It's not the top tier yet, but it's definitely respectable.
Okay, good. And anything else on the governance front?
Yes. Additionally, the company is certified under the Anti-Corruption Progress Indicator. This reflects concrete, verifiable efforts against corruption within their operations. So putting together, these are all very positive signs for investors who prioritize responsible and ethical corporate practices. It shows a company that seems focused not just on the bottom line, but also on its broader impact and operational integrity.
Okay, so wrapping all of this up. Strong performance driven by strategic shifts, ambitious future plans including new capacity and navigating global trends, analyst targets suggesting upside but caution on timing, improving financial health, and positive steps on governance. What does this all mean for you, our dedicated audience, as you consider CCET?
Right.
Let's bring all these threads together now for a general outlook. What's the overall investment appeal? What's the long-term stability look like? Is it a good fit? And how does it stack up against its peers?
Okay, let's try to synthesize this. When we pull all these insights together, the picture that emerges is really one of a company undergoing a significant and seemingly quite well-executed transformation. You have Maybank Securities, for instance, rating CCET as a top pick within the Thai electronics sector. That's a strong endorsement. They're forecasting that strong core profit growth, 4% in 2025, may be conservative, but then an impressive 31% jump projected for 2026. That's a very positive long-term outlook, especially, again, for an EMS company.
And the core drivers behind that optimism?
They're pretty clear and compelling, I think. First, that strategic pivot to higher margin products we discussed, especially the SSDs feeding into the booming AI server market and the smart wearable devices. Second, that anticipated influx of new laser printer client orders driven by those geopolitical supply chain shifts.
Right, the potential 20-25% revenue boost.
Yeah, potentially, yes. And third, the increased manufacturing capacity coming online from their new factories, especially the already operational Factory 16, and that strategically important new facility in Brazil with its favorable tariff rates. These are all expected to fuel future growth significantly. It really feels like a company actively trying to reshape its destiny.
It sounds compelling, but every investment has risks. What are the key ones investors absolutely need to keep in mind here?
Crucial question. And yes, there are definitely risks and considerations. First and foremost, U.S. tariff uncertainty. It remains a significant external risk factor. While CCET has, as we detailed, a proactive strategy and contingency plans involving relocation options.
U.S., Philippines, Brazil plan.
Right, but the specific impact of potentially fluctuating tariffs on their future earnings is still genuinely difficult to quantify precisely. Investors should absolutely be mindful of ongoing trade policy developments, how they might evolve, especially perhaps after U.S. elections. It's a known unknown, if you like.
Okay, tariff risk is number one. What else?
Second, the valuation assessment. As we discussed, the stock price, at least when analysts were looking closely around 7 THB, was considered tight. It might already reflect a good portion of the base case projections.
So limited immediate upside, maybe?
Potentially, yes, without further positive catalysts or news flow. It urges caution for those looking for quick gains at potentially elevated levels relative to the current confirmed news. Third, those seasonal and volatility factors we talked about.
Q1 low season, special items.
Exactly. Given Q1 is typically slow, coupled with the unpredictable nature of special items like loss on disposal impacting quarterly results, the stock is just inherently prone to volatility. The consistent analyst suggestion is to perhaps wait for Q1 results for a potentially more favorable entry point. Don't chase it.
Got it. Any other risks to monitor?
Two more quick ones. We need to monitor margin consistency closely. Despite the strategic shift to higher margin products, analysts did note a slight dip in margins in Q4 previously. So close monitoring is needed to ensure CCE can consistently maintain or increase those margins, ideally above the 5% level as they scale up production.
Keep an eye on margins.
Yep. And finally, keep an eye on administrative cost management SG&A expenses. While AI is helping reduce costs on the production side, investors should just track potential fluctuations in these overhead expenses. Sometimes rapid expansion can lead to temporary increases here, so it's worth watching.
Okay, so a high-growth company, clear strategies, but definitely not without its risks. Tariffs, valuation, timing, margins, costs. For whom is CCET stock most suitable then? What kind of investor profile fits this story? And how should they think about it within their broader portfolio?
Well, based on everything, CCET is really characterized as a stock most suitable for investors with a higher risk tolerance.
Because of the volatility and cyclicality?
Primarily, yes. Due to that inherent volatility we've explored and the cyclical nature of the broader electronics industry, which can experience significant boom and bust periods. Because of this, it may not be an ideal core portfolio holding.
Meaning not a foundational buy and hold forever type stock for everyone.
Probably not for a very conservative investor, no. It's likely not the kind of foundational low volatility stock you'd build a very conservative long-term portfolio around. Instead, the advice seems to be that investors should consider allocating a defined, moderate proportion of their investment portfolio to CCET.
So not betting the farm.
Exactly. Think of it more as a strategic, perhaps even tactical, growth-oriented play within a well-diversified portfolio, rather than a central cornerstone holding. Manage the position size according to your risk appetite.
Okay. And finally, how does it stack up against its peers in Thailand? You mentioned Hana, SVI, earlier. What are CCET's comparative strengths?
Right. When you compare it to peers in the Thai electronics sector like Hana and SVI, both strong companies in their own right, CCET really seems to stand out in a few key ways right now. Analysts point to its strengths lying in its perhaps more concentrated revenue base.
Concentrated? Is that good?
It can be. If it suggests strong, stable, long-term relationships with large, big tech clients, that can be a significant competitive advantage, as these clients often provide consistent high-volume orders and potentially co-invest in technology.
Ah, stickier relationship.
But potentially.
Yeah.
And critically, its strategic involvement in those key high-growth areas like AI, specifically through its production of SSDs for servers, positions it uniquely for future demand in a way that might differ from its peers' focus areas.
So that specific niche focus is a strength.
It seems to be viewed that way.
Right.
So while ADA and SVI are strong competitors, CCET's particular focus and strategic positioning in these high-growth niches, coupled with its proactive capacity expansion and those detailed risk mitigation plans, arguably give it a distinctive edge in the current environment.
And that wraps up our deep dive into CCET. Wow, we covered a lot of ground there.
We certainly did.
We really hope this comprehensive analysis has provided you, our listeners, with valuable insights, helped you connect the dots on what's truly important about this company, and maybe given you a clearer perspective on its place in your own investment thinking.
And just remember, in the world of investment, Knowledge is always most valuable when it's properly understood and then applied thoughtfully. There's always more to learn out there, and critical thinking is really your essential tool for navigating the uncertainty and hopefully seizing the right opportunities.
Well said. Finally, if you'd like us to cover any specific stock in a future deep dive, just let us know. We love getting your suggestions. And please don't forget to follow, like, and share to support our team. Thank you.